Zoom recording.
There you go.
Yeah, it's just too many of them this week.
Never too many.
All right, welcome everybody to another edition of Think with a Drink. This is the weekly webinar series brought to you by the ARIES Foundation for Financial Education. And this week we are doing, I don't know, Craig, if it's a fun one or not a fun one, like how to reduce your taxable income. But I just feel like every time we're talking about taxes, it's never a fun thing.
Well, taxes aren't fun in general, but saving money is.
Saving money is always a good thing. Yeah. So before we get started with this real pre-flight checklist for everybody, just know we are recording this event. We do share it on our website. We share it on our YouTube channel. Just ask that you keep your microphones muted. You don't have to worry about the cameras because only what's being shown on the screen is being recorded. There is a chat box, however, so do take advantage of that if you do have questions as we're going along. And my co-pilot, who I will introduce in a second, is here to sort of answer those, man the chat box, chime in as we go along, and keep us on pace for this evening's flight. Speaking of your pilots for tonight's journey, my name is Tom Alessi. I am the president of the ARIES Foundation. I've been in financial services for 24 years now. I'm an investment advisor. That means I act as a fiduciary whenever I'm giving guidance or advice to any of my clients. I want to bring my vice president, Greg, if you can introduce yourself.
Sure. So I'm Craig Richardson. I'm the vice president of the ARIES Foundation. I've been in financial services for over 19 years now, and I specialize in working with individuals and families to help them to find their financial goals and have a better relationship with their money.
And as I said, Craig will be chiming in as we go along on this very happy of topics for this evening's webinar. So we'll see what happens there. But he's also there to man the chat box and make sure that we move along in terms of this conversation. We told you to Think with a Drink is brought to you by the ARIES Foundation for Financial Education. You can visit us on the web. It's ariesfoundation.org. And just know the mission behind ARIES is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you are actually in a relationship with your money. And just like every other personal relationship that you have, there are behaviors and triggers that cause us to act, well, a little irrationally sometimes when it comes to dealing on our money and our finances. All myself, Craig, the rest of the ARIES team tries to do is help everyone sort of take a back step and just sort of look at the overall picture and figure out why some of those behaviors happen and how you can get a handle on it to be better and have a better relationship with your money. There's a lot of words on the screen here. These are disclosures. I'm not going to read them all. Just know we're a nonprofit. The whole idea here is we're doing this for educational and informational use only. We do record all of this. We do share it. So all that we ever ask is that if you're going to share it, just do it in an educational manner. We do, myself, Craig, the rest of the ARIES team does recommend, though, if you do ever have questions and they are of a tax, legal, or financial, that you seek out the help of a professional to get them answered. I got through that, Craig. That was the hard part of this evening.
Yes.
Now we come to the fun part. We call this Think with a Drink. There's a reason we call it Think with a Drink is because a lot of times the financial money matters, things of that nature tend to feel a little intimidating for folks. It tends to feel a little overwhelming sometimes. And so Craig, myself, the whole idea here is trying to make it a little bit more casual, a little bit more relaxed. And we can't think of a better way to do that than if we're kicking back and having something cold to sip on while we're doing this. And because we're talking about taxes, Craig, for tonight, I figured everybody could use a big hug. So this is a neon beer hug. That is what I'm going to be drinking this evening. This is from Goose Island. It's billed as an electric mix of hops, though it comes in at a heavy 7% ABV. So this is not a lightweight of an IPA here. If you're looking to pair some, these type of IPAs one of the things we try to do, we try to talk a little bit about food pairing, maybe some spicy dishes, great, like a curry dish or maybe like a Thai dish type of thing. Specifically like with shellfish, like shrimp and stuff like that.
Okay, yeah.
Cheeses, right? They always go well with IPAs, but something peppery, Monterey or pepper jack, something like that, or maybe something like a sharp cheddar as well. So that's what I'm drinking. What do you got this evening?
I am bringing back an old classic, and because I found it with zero sugar, I have an A&W root beer. So I am having a beer. It just happens to be a root beer.
So not you're not your grandfather's root beer or whatever, that spiked stuff, none of that. Just
oh, sarsaparilla, right?
No. There's actually spiked root beer now.
Oh, is there? Oh, okay.
Yes.
Oh,
You'll
no.
have to go find that as your next endeavor to find spiked root beer. Anyway, Skol.
Oh,
I can smell the hops. It's nice. Got a very clear finish. Okay. We're off. All right. So agenda, we do a little bit of what we're thankful for right now. We sort of try to look back and say things that we're thankful about. As Craig had said, it's tax time again. Never any fun. We'll go through some of the usual deductions that are out there that maybe you haven't thought about. And then the second part is going to be, we're going to get creative with you and try to give you some of the things that you probably never thought about, maybe some that don't apply to you, but they're certainly available. And as always, we're available for Q&A. So things we're thankful for, Craig, I'm going to start with you. I think I started last time. What are you thankful for this week?
so this week, actually, both my daughters are on spring break from college. They're both coming home tomorrow. And I'm thankful that I'm get to see them both, and they actually still want to spend time with me, which is kind of amazing.
That is very nice. That is a very cool thing. I'm jumping ahead a little bit because mine is that I am going to be going away next weekend for a gathering with buddies. We're going down south. We're going to do a golf weekend getaway. So really looking forward to that, especially where the weather has been a little chilly around here. I get to go south, play some golf. Going to be a lot of fun.
I just want to know which one of us is Ray and which one of us is Lewis.
Depends on who you feel, basically, You're looking good or feeling good, right?
Both.
Oh, there you go.
I'm Ray Lewis.
Right. All right. So taxes. Look, so whenever we talk about taxes and dealing with taxes, and right now, this whole thing that we're doing is all about looking backwards, right? Because we're looking at 2022. Not really looking at 2023 and any of this, because we're trying to reduce your taxable income. You get the maximum refund for filing your taxes this year. So this is sort of like the whole CPA accountant thing, Craig. Like we're looking backwards. We're looking at last year to help you with your filing in terms of this.
Right. So we're not really, so we play them on TV, right?
Yes, absolutely. All right. So the first place is an IRA, right? So an individual retirement account. This I think, Craig, gets overlooked a lot, because especially if you were contributing to like a corporate retirement plan, which is great and it's wonderful if you've got a 401k or a 403b at work. But the problem with those is we sort of refer to those as woulda, coulda, shouldas, because all of the contributions had to be made within the calendar year 2022. If you are sitting here and going, gee, I wish I had put more into my retirement account so I would have lowered my taxable base, you can't do it with the corporate retirement plan because you can only do it in the calendar year.
Right.
You do, however, have the ability to either contribute to, if you have an open IRA, or open one and fund it up until tax filing time.
Yes. Yeah. Like I said, it's a great catch up for somebody who didn't maybe put away as much last year as they were hoping to. And a lot of times you just don't know, right, what your cash needs going to be, especially when you're going through a year where we had some inflation. Maybe you didn't put as much into your IRA, 401k as you wanted. And now, you can get a chance to do a little bit of makeup. So, yeah.
Yes, absolutely. So there is still time all the way up until it's April 18th this year, though technically it's really like the 13th when we're talking about trying to open an account and fund it and get the check in, blah, 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 all of that stuff. Right. So just don't wait until April 17th or 18th and, try to show up at somebody's office and go, hey, I want to open an IRA today. That's not going to work, right? So Believe me, I've seen
Look
it.
funny and send you away, right?
Yeah. But if you are under age 50, the amount was for last year was 6,000. If you turned 50 last year, or you are over 50 last year, that amount was 7,000 that you can put away. Not a staggering number by any means, but like Craig said, it's a little bit of a catch up that is available to you. You know, if you're sitting there saying, gee, I wish I would put more away.
Yeah, especially if like your tax brackets on a teetering on the line there, you want to get yourself into the lower bracket, right?
Yes, absolutely. And there's another tool that you can do that with if it's available to you, and that's a health savings account. So here's the thing with the HSAs. HSAs, that's a health savings account. This would be through your, if you're working for a company, if the employer is offering it to you, maybe this was something again, all right, they were putting money in, I didn't really contribute anything to it. That happens sometimes. And then the situation is you have the same ability, just like the IRA, to do a catch-up contribution all the way up until tax filing time with your HSA.
Mm-hmm.
Single individual last year, I think it was 3,700. Family, it was 7,300, something like that.
Yep.
So if you didn't contribute anything, there's another, if a family, 7,000 to your IRA, if you're over 50, 7,300 to your HSA, now we're talking, we're putting 14,000 away if the HSA is available to you.
Mm-hmm.
If it's not available to you, this is something, maybe a conversation with your employer, the possibility of having it available at next open enrollment time, because this is a triple tax benefit. This money goes in pre-tax,
Yep.
It grows tax deferred, and when taken out and used for medical expenses, whether now or in the future, it's tax free.
Yeah, I always say this is fantastic too for those people who want to retire before 65, before they can get Medicare, because you can use the HSA to purchase your own personal insurance. You can use it towards insurance premiums. So yeah, so that's another reason. Why would I want to build up all this money in there? Well, there you go. There's another reason to do it.
Right, and it's not a use it or lose it tool. This is it can keep rolling, and you can actually even invest it at some point if you want to do that with it. So there's a lot that's available through the HSA, and it's one of those, there's another catch-up tool that, hey, if I didn't pour money into it last year, I can do that now.
Mm-hmm.
All right, do some harvesting. Greg, that's not directed at you, that big L on her forehead there. That is to sell losers, right?
Oh, sell losers. Okay.
Yes. So this is, one of the things with this is you talk about tax harvesting. Unfortunately, we're sort of past the window, right? Because we're in the new year. So this isn't really a looking back thing, but this is more of a conversation about talking about if you're thinking about doing it, now still, because let's face it, most investments are still down in terms of it. Just realize if you've been holding it for a while, the capital gains, the income numbers have gone well up, right? So, you've got to be making over 500,000 as a single filer to get out of the 15% bracket for a capital gains at this point.
Wow. That's fantastic.
This year, the number went to 44,000. So like literally, the earnings level there, that's 44,000 before it kicks in and gets into a 15% tax bracket. You're in zero with the capital gains all the way up to 44,000.
Wow, that's amazing. So you could actually pull, if you're single, you could pull $41,000 out of your investments with capital gains and not pay any tax on it.
Correct.
That's fantastic.
That's a way to, again, we're trying to find income and find it. And so, maybe that's and let's face it, now it might be, look, I'm doing that, but I got a loss. So now this is one of those, I can actually, carry that forward in terms of the loss.
Now, could you possibly do that? I know some companies give called restricted stock units. Can you do that with those as well?
Wow, I have no idea. That's a good question, though.
We'll have to
I'll have to look at that. I'll have to put that down, whether or not you can do that with the restricted stock option. I hadn't thought about that, but that's an idea. But here's one of the things with this, whenever we talk about tax harvesting, because it's a great tool and it's something to be thinking about, especially with down markets and everything that happened. but it's like, don't get crazy with it. You know, there's an adage to this, it's like don't let the tax tail wag the investment dog is how they, don't let it throw off your portfolio because you're trying to take advantage of all this tax harvesting and suddenly find yourself with, wait a minute, because you can't go in and immediately buy back the same thing. It's a wash sale. You got to wait in terms of dealing with it. So you can't like sell something and then turn around and immediately buy it back.
Gotcha.
You can buy similar, but you can't buy the same thing.
Right. So you may want to sell off something maybe you're overweighted in.
Yeah, or something that you're like, okay, I don't want to have this anymore. Yeah, I'm done with Meta. That's it. I'm out, in terms of dealing with it.
Gotcha.
The American Opportunity Tax Credit. So this is for somebody who might be either trying to invest in themselves, higher education, but not a child's tax credit. You're doing it for your own educational purposes, maybe for work. Maybe you've gone and you spent money. I wanted to improve myself, or I was trying to get a little bit more of an education or a degree or some program that I needed to do. We have the ability to write that off, or write a portion of it off as far as this American Opportunity Tax Credit. So it's something that's there, that's available if you happen to be doing it. Now, if you didn't do any education last year, again, we weren't really thinking forward, but it might be like, well, I wanted to take a class, now I know I can write that off, or at least a portion of it if I do that.
Now, is it a deduction or is it actually a credit?
It's a credit.
Oh, okay. So it's even better than a deduction because you're getting tax credit.
Correct.
And is that dollar for dollar, or we have to look that up?
No, it's a portion. There's a limit in terms of how much. It's like 20 or 25%, and there's a threshold there that you can get to it, basically, and how much you actually earn will limit how much you can get. But I mean, they've extended the numbers on that as well. So all of those have gone up. Well, but it's there.
Yeah, that's great.
The earned income tax credit, right? So this is for lower income, right? And this gives you the states that it's available into. It's a funky way of doing the U.S. tax, in terms of looking at the states there, but the idea here is, if you are a lower income earner, and what is lower income earner is, it varies state by state. It varies in terms of how that's looked at. It's varied by the number of dependents you might have. So I just know that the statistic is that about 25% of the people who are eligible for this never filed for it.
Mm-hmm.
So it's a number that's out there. You got to be at least 25 years old, but under 65. You got to not be claimed as a dependent. So there's all these factors that go into it, and how much you earn, and like I said, the number of dependents sort of drives it by state. But it's something that's there, that's at least looking at. It's at least worth going through. Okay, so those are our general ones. Yeah. So now we're going to get creative with you. So now we're going to have real fun with you in terms of going through this, right? So
recording now?
No, these are all legal. These are, it's what is that? The ethical and moral thing. It's like I've got to pay taxes, but the tax code gives me the ability to do some of this stuff.
Avoidance and evasion. Yeah, it's a thin line.
Yes, right. Before we do that, we do want to just remind everybody, one of the things that we do here at ARIES is we're always trying to, like we said, help everybody have a better relationship with their money. And one of the ways that we found the easiest way to do that, and we put a stat out this week, Greg, where the bulk of the audience, the bulk of the people out there want to have that one-on-one, that personal interaction in terms of learning or understanding education and what they're trying to do. So we make that available. You can see the link on there, but there's also a QR code. You can just scan that QR code. We figure it's easier, especially with the recording. Shoot the QR code. It'll open up our calendar, and we're happy to have a conversation with anybody. All right, Craig, you ready to get some real funky here with this now?
I'm curious to see what you came up with.
See what we got. So parenting and lifestyle, this is what we're doing right now. So the first one is, hey, by the way, if you got clarinet lessons for the kid, you could write that off as a medical expense.
What?
Yeah, so if there's a misaligned or the dentist tells you that, hey, the kid might need braces or something,
Yeah.
clarinet lessons could substitute for there. So if the kid's taking clarinet lessons, the cost of those lessons, you could write them off.
Only clarinet though.
Only clarinet. It's the only one that fits because of the way the reed is set and how you have to work that instrument.
I'm never going to look at clarinet players the same again.
There you go. Summer camp or sports camp, right? So if you're working and the kid, you got to find some place to send the kid, then you might be able to write off camp if you send the kid to camp during the day if you're both working. Leftover wedding items. This is a one-off thing. Well, for some people, it's a one-off thing. For some others, it might be more than a one-off thing. But if you had a wedding last year and you donated the flowers or leftovers or any of the stuff that was from the wedding, you can write that off. It's a charitable deduction. If you know somebody who's getting married this year, you can let them know, hey, if you donate those flowers or the arrangements or whatever, you can take that as a write-off.
Wow. Yeah. A lot of times you see that, the flowers get donated to say a church afterward or left there at the church when they leave. So,
right.
And they're expensive. Flowers for a wedding are a lot of money.
Absolutely. That can all be written off.
No one would ever think. Yeah. I never would have thought that. I had no idea. That was pretty good.
And paying wages to your kids. Now, this only counts if you have business income and you're trying to write off the business income, but you can pay the kid to do stuff, help around in your business and do things like that. And they actually can write off the kid.
Wow.
Last one, and this one's sort of out there because everybody sees it because what are those stupid things they put on the roof there? The
solar panels.
Yes, those type of things, but other, appliances and other things that can make your home more efficient. If you did that or bought it, just realize that that's a write-off. That's something that you could deduct.
The things with the Energy Star rating. Right.
Yes.
Mm-hmm.
Okay, moving on to more funky stuff, career and finance. So, specialized work costumes, uniforms, things you need to purchase for your work, whether, in this case, that shows a clown, but I was thinking of clown college for some reason with this.
You didn't pull it out of your own closet, did you?
Yeah, I don't know why, but no, but a lot of times, there are certain places that you have to purchase or buy certain types of clothing
just for that
work, like restaurants do that a lot and things like that. That can all be written off. Your first job, if you're moving and you have to move to go to that first job, all of that expenses can be written off. So maybe not for the older folks in the audience, but maybe they have children or your kids or somebody that who's getting a first job and has to move away to do that. They can certainly write that off.
Interesting. Okay.
And this is a funky one because this is kind of fun, but it's just like the whaling ship repair.
Oh, now I got to buy a whaling ship.
No, only Native Americans are permitted to be whalers. So you'd have to go in partnership with somebody and do that.
Oh, okay. Yeah.
But yes, you're up to $10,000 to repair a whaling vessel.
Oh my gosh.
So the next one's a little funky. And the only reason I put this in with the gambling is because tomorrow, literally the betting window opens tomorrow on online gambling in Massachusetts.
Wow.
So online sportsbook betting has come to Massachusetts and it opens tomorrow, Friday, March 10th. They will start, all of those, whatever those companies are that let you, MGM and all of those places that you bet online, that is available as of tomorrow. Now, here's the whole thing with gambling losses. It's not really a deduction because you have to claim a gambling win in order to claim a gambling loss.
Oh, so you can only lose what you won.
Correct. Right. So if you say, and if it's like, well, hey, like most gamblers, I won 2,000, but I lost 3, they're only going to let you write off the 2.
Gotcha.
So just know that there's a fine line there, and it's not like, hey, I can just, look, I lost $3,000 last year gambling. No, because that would be like the government would be funding your gambling addiction, basically, if they were letting you do that without you claiming winnings.
Yep.
All right. Medical. This is a good one for you, Craig, because I know you have a pool,
I
right?
do. Cool.
But if you had arthritis
Ah,
and swimming was prescribed for your arthritis condition, you could write off the pool.
wow. That's cool. Well,
Yeah.
I have arthritis.
Yeah.
But
Quitting smoking, right? So smoking's any type of, I don't know if vaping, I meant to look on that. If vaping, I assume vaping is included in this.
I would think so.
That if you were trying to stop vaping, that you would get the same benefit to write it off, since the most people are now vaping versus smoking. So I'm assuming that falls in the same category, but don't quote me on that because I don't know the answer to that. This one doesn't really apply to us because we're dudes, but we do have daughters. So pregnancy tests, right? They can be deducted. You don't need the physician's administration, just the cost of the pregnancy test.
Okay.
And then if you were told to lose weight, right?
Yeah.
So any weight loss program, Weight Watchers, etc., all of that is deductible. You're able to take that deduction as part of that.
Yeah, and just as an aside, a lot of times when your health insurance, if you join a gym or do some kind of fitness program, they'll actually give you money back towards it.
Depending on the provider, yes, there is that
$100 a year or something like that. Yep.
Correct. Yeah, and sometimes you can look at it and see that there's actually a deduction for the kids' sports, like programs and things like that they do, falls under the same category.
You can get the write-off on one side and get the income on the other. It's a double win.
There you go. Yeah. All right, so taxes, like we said, right, we're dealing with taxes and going through it. And so here's the thing with taxes, getting a refund is great, but ultimately what that means usually is that you're giving your uncle a free loan because the government is just giving you back the money that you set aside, but they didn't give you any interest on it. So the conversation Craig and I have with everybody is talking about, what did you do? Right now is the time to be doing this. Like, I'm filing my taxes or I'm meeting with my accountant. Where did you come out? If you came out with, it's like right about break even. I either got a little bit or I owed a little bit, fine. Yep. But if it's, well, no, I got this big number. I got this nice refund that's coming to me. Well, okay, that means you just gave that money to your uncle for a whole year that you didn't get any interest on it. And if you're not a good saver, right? So this is one of the things that Craig and I say with this. If you're somebody who struggles at saving and putting money away, and you use the refund for good purposes, not that we're telling you where or how to spend your money again. You're not blowing it, basically. Okay. But then that's okay. Because this is at least a forced savings to you. But for most of us, if you're good about saving money and putting money away and you're staying on with that, then giving Uncle Sam free money for a whole year doesn't make a whole lot of sense. And you should look at changing your deducting amount, right, Greg? The what is that? The W-4?
Yeah, right. Your allowances on your W-4, which you can change at any time. All you have to do is just go through HR and you can change that. A lot of people don't realize they can. The other thing I think you should do in tandem with that, Tom, is if you are getting a large refund, I'd say whatever it is you were getting for the refund, divide that by the number of paychecks you'll get during the year and have that amount automatically drafted into your savings account for yourself. Then you'll still have the same amount of money at the end of the year, but you may even get a little interest on it.
Right, you'll get something. Well, at least even nowadays, you'll at least get some interest on it.
Right, absolutely. Or, be putting it into your 401k and then you're getting a tax deduction.
Right, or the HSA if it's available, right? There's the other thing, right? Something that you can do with it that's going to be even more beneficial than letting the government have it for a year.
Right, absolutely.
And that's pretty much taxes. Like we didn't want to beat up and spend too much time with taxes in terms of dealing with this. But again, if you ever have any questions, any concerns, always feel free to reach out to us. Shoot the QR code on the screen. It'll open up our calendar. You can schedule a time. We're happy to answer questions. Anybody, anytime, whatever's on your top of mind, front of mind. Yes, we're talking taxes right now. But, there's other stuff going on in the world, and that sort of leads me to the next slide, which is we keep the think with a drink theme going and go to what's on tap. And next week, because Craig was just having fun where we were doing so many of these holiday events, like between Groundhog Day and President's Day and everything else that was going on. So this week, St. Patty's Day is on Friday. We're going to do a pre-St. Patty's Day event on Thursday, which is It Ain't Easy Getting Green, not being green, getting green, because twofold. Green is money, so that's accumulating wealth, but also there's a whole push on ESG, which is environmental, social, and governance. You know, this whole thing about, am I being socially responsible with my investments, and how do you look at that as far as balancing versus your return? So this is sort of it ain't easy getting green. 323, that's 3 ways to manage your day-to-day expenses, because let's face it, everything is more expensive. Inflation is through the roof. The Fed's talking about raising interest rates, continuing on in terms of that going forward. So this is just 3 ways to sort of get a handle on your day-to-day. And at the end of the month, April is financial wellness month, Greg. So this is a march into financial wellness. A little, playing on words there in terms of it. But we're going to just touch on financial wellness, what that means, what are the pillars to financial wellness, and how do you sort of try to get that in your life.
Sounds like a good lineup.
Great lineup. So, questions, if you ever have any questions, you can go to the website, ariesfoundation.org. There's a contact us and a way to reach us on there. You can shoot us an email. It's info@ariesfoundation.org. But certainly the easiest way is to just shoot that QR code, and that'll open up our calendar and be, right to us, and then we can schedule a time from there. Any questions in the chat box, Greg?
I have no questions in the chat box at this time.
All right. So on that note, I am going to say, listen, thanks, and have a great evening.